This is our How to Buy a Home class. My name is Victoria Henderson, and this is my husband, Marshall.
Good morning.
And we're joined by Ramez Fahmy with Caliber Home Loans.
My name is Ramez Fahmy. I work with Caliber Home Loans. My office is in Rockville, Maryland. I've been originating mortgages since 1994. So I've got to see a lot of different markets, and hopefully we'll bring some of that knowledge to you today. We are a national company. I'm a local lender. We have people coming into our offices every day and helping people generally in this area, but I'm licensed in about 10 different states. So if you happen to be looking in Florida or Maine or somewhere like that, I'm licensed in most of those states as well. So I look forward to kind of giving you a little bit of information to help you start with the home buying process. So this first slide just talks about pre-approval. It comes first, right? So typically what will happen is Vic or Marshall will sort of say, hey, I want you to talk to Ramez. He can help you kind of get your finances in order. This pre-approval process typically starts with a phone call or like a call like this, a web call. And we just kind of like to discuss lots of different things. The thing I would say, the most important thing about the pre-approval process is just communication and clarity. I'll ask lots of questions like, not what do you qualify for, but really kind of more what are you interested in paying? How much money do you have set aside for buying a house? And then we kind of help try to build out some numbers for you so that when we turn you back over to Marshall and Vic, you know that you're looking in the right places. I tell people the worst thing you can do is go see a house, fall in love with it, then come back, talk to me, and then realize either one, you don't qualify for it, or two, it's just sort of out of your comfort zone. So if we move to the next slide, I think we can cover a little bit about what we talk about throughout that process. Everyone on this call has some bit of interest about buying a house, and they want to just sort of know what is it that that they should be doing or not doing when preparing. Everyone has the best intentions in place, but as I tell people, you need guidance from people like myself, from Vic, Marshall, because things that you might think are the smart move to do when getting ready to buy a house aren't necessarily going to be the right thing to do. So, for example, know that when you're going to talk to someone like myself, you're going to need to provide some information, right? So just start to prepare knowing that you're going to have to provide pay stubs, W-2s, maybe IDs, potential copies of your tax returns, things like that. Make sure that those are readily available for us to do our job properly. Know that when you are going to be putting a contract on a house, you're going to need to provide a deposit of some sort. It used to be checks. A lot of it is wiring back and forth now. So Vic and Marshall can go through that with you. So things not to do. Don't feel like you should start moving money all over the place. Don't start closing accounts that you have that are open that have really good payment histories, because those types of things can impact your credit potentially. Typically when you have an account, credit card, maybe that you've had for 9 or 10 years, even if you're not using it, so long as you've been paying it on time, so long as that account remains open, it's really kind of beneficial to your credit scores. Now, if you close those accounts, it's not they're going to hurt your scores. It's just not going to help it as much. So we want to make sure that those accounts stay open. If they're active, make sure you're continuing to pay those accounts on time and a timely basis. Don't go out. Yes.
We've got two questions. One,
yes. Okay. Yeah.
Did you pull the buyer's credit during the pre-approval, and if so, does that impact their credit score? And real quick, Cameron, yes, the recording is going to be available for you to look at again later on.
Got it. So yes, so the question about when we pull your credit, how does it impact your score? I always tell people, if you generally have good credit, it really shouldn't matter how many times your score is pulled. Now, I say that to like if you're looking to get a mortgage, here's where it can be negative. If you're already maxed out on a lot of your cards, and then last month you went to a car dealership, they checked your credit, and then you went down the road to Macy's and they were offering 10% off for purchase of a product. Now you pulled their credit, so now it's like you're seeking multiple types of credit. But with a mortgage, typically what happens is you're only trying to get one mortgage, right? So if I pulled your credit and then someone else pulled your credit, a week later, really shouldn't have any impact on your scores at all. But generally, it's part of the process. We will give you advice based on your scores of things to potentially make your score higher, or tell you, hey, don't do this so that your score doesn't drop. But generally, when we pull that credit report, it's good for 120 days. And so if we pull your credit today, you've got excellent credit, but let's say in 6 months from now, you're going to buy, we'll have to pull that credit again. But I'm not going to pull it again until you're like ready to move forward. Like, okay, now we're ready to go. So we pay attention to the amount of inquiries that you have, but if you've got good credit, it really should have minimal impact on you at all. We've had people, a lot of people come from out of town and they're switching jobs to come to the area, right? Typically, they haven't started that job yet. We can still help you get a mortgage. But where we would say don't quit your job. That's a salaried position so that you can open up your own business, right? Typically, that type of employment self-employment requires a 2-year history. So if you're going to switch jobs, it's best to change it in sort of the same industry and a similar pay structure, right? So if you're going from one salary job to another salary job that is making you more money, yeah, that's fantastic. But if you're leaving a salary job for a 100% commission job or self-employment, then that could kind of derail your process a bit. So hopefully that kind of helps cover that slide. Yeah, and once we're engaged in the process, what I would say is just kind of thinking about like kind of fiduciary relationships and things like that. We're not sharing all your personal information with Marshall and Vic. So we're also kind of communicating. Once again, I'm going to use communication a lot in this conversation with Vic and Marshall to say, okay, this is kind of the range that they should be looking in. And then if you add like, a $700 car payment, that could impact your qualifying by up to $100,000, right? So that's an important thing to think about when you're qualifying for a loan. Yeah, so typically when we had talked about the pre-qualification process, and I sort of use this, the 5 C's of getting a mortgage, right? And I'll kind of go through them individually and kind of what we typically gather to kind of validate these items, right? Because a lender is all about, we do need to know a fair amount of your business so that we can properly qualify you and make sure that we're getting your loan closed and settled and delivered and fine, and that we don't have any issues down the road. So first thing we look at is like, what is your capacity to pay back this loan? So this is what we call our debt to income ratios. So what is the percentage of the housing payment, right, as a percentage of your gross monthly income? That's your kind of income ratio. And then your debt ratio is the proposed mortgage payment plus whatever your minimum monthly debts are on all your different liabilities, from car payments to student loans to minimum payments on credit cards. If you pay alimony, child support, anything like that, all those things are taken into consideration. Also, regarding income, what are we looking at? We're looking at your salaries at your jobs. Do you potentially receive Social Security benefits? Do you receive retirement pay? There's lots of different types of, do you receive alimony or child support? And if you are, how long is it going to last for? So there's a lot of things that we ask for, lots of ways to qualify you, and there's certain documentation in each one of those sort of respects as to what we would need. The next thing is the capital, right? The capital is the money that you're going to use for your down payment and closing costs, right? That money can come from a number of different places, right? So first and foremost, typically your own checking accounts, savings accounts, things like that. A lot of times where our money will come from. So maybe you've been saving up money and you've been investing that money in in stocks and bonds and mutual funds and things like that. A lot of times people are liquidating those assets for the purposes of buying a home. Some folks are fortunate enough to have a family member who's willing to help them out and give them a gift for buying a house. It's totally acceptable in most of the loans that we're doing. We just need to make sure that we're properly documenting how that money is being transferred. There'll be a little bit of information that you would need to get from the donor of that money. And typically what we're looking at is, sort of a 2-month window of time. So if you've got $50,000 in the bank and it's been there for the last 2 months, we're not going to ask you, where did that $50,000 come from? But if in the window of time that we have your bank statements, we see a $20,000 deposit or a $30,000 deposit, we're going to ask, hey, where did that money come from? Because we want to make sure that wasn't money that was borrowed. When I say borrowed, like in an unsecured fashion, like a cash advance on a credit line, a personal loan from a bank. But the type of money that you is technically not borrowed, but you would think of it as being borrowed, is that, hey, I'm going to take a loan against my 401k or something like that, or some sort of collateralized loan. So basically secured against another asset. So that's down payment. Now, there are other, we'll talk about this a little bit later. There's some programs out there that the states offer, whether it be Maryland, DC, Virginia, where they have some down payment assistance loans and things like that. And depending on those products, sometimes that money can be borrowed. The next thing that we look at is the collateral, right? So any one of these loans that we're going to do for you are secured against the property, right? And that property is going to have a value associated with it. And the way that we determine what that value is by sending out a real estate appraisal, right? The real estate appraisal, we'll talk a little bit about it, but they go out and they look at the property that you're buying, and then they compare it against other properties that have recently sold. There's another slide a little bit later. I'll get a little bit more into it, but that's the third C. The next item, super important, right, is your credit and your credit reports. Someone asked about inquiries and things like that. What I would say is that is probably one of the least impactful things on your credit score. But we're going to check your credit score, right? And what the credit score is kind of like your report card for how you've paid your debts over time, right? There are a number of factors that they look at. It's not just the payment history. It's the amount of outstanding credit that you have. It's the amount of available credit you have and the proportion of the balances to the credit limits. It's the longevity of your credit. So if you've had accounts that you've had for 10 years, those are really, really impactful on your credit, especially if there's a good pay history, versus an account maybe that you just paid or that you just opened. We don't like to see maxed out credit cards, things like that. And then kind of one of the things that can really hurt you is late payments. And when we talk about late payments, these are more than 30-day late payments that have been reported by to the credit bureaus by the creditors. So a much older 30-day late payment, maybe you had an issue 5-6 years ago that shows up on your credit, that late payment isn't going to hurt you nearly as much as a late payment that you had in January or February or December of last year, right? So if something recent is going on, it'll be more impactful on your credit scores. So hopefully that kind of helps, with the credit piece. And all that information is sort of, put into one system, and the scores that are generated are not going to be the same scores that you see from your credit card vendor, right? Probably everyone on this call has a MasterCard or a Visa or has access to places like Credit Karma and things like that. Most of those folks give you some sort of idea of what your credit scores are. While those credit scores are helpful to give you a general idea of what your score looks like, they're using a very different model that the credit reporting companies use for kind of the educational model versus what they would use for a mortgage company. So when someone says to me, hey, I have an 850 credit score, I know that they pulled their credit report or they got that credit score from their credit card carrier. Because in our world, typically the really just kind of the best kind of credit profile out there typically isn't going to have a credit score, greater than 810 to 820. So when you see 850, we know that's a different model, but an 850 or a 790 in our world is kind of generally going to yield you the same interest rates. So
Ramez, we've got a quick question. We got a quick
Yes.
question from Simon. He says, if a person pays his credit card in full, is it a plus or minus towards a credit score?
It's a plus. Yeah. And the reason I say that is they brought in the last number of years, not only do they have these payment histories, but they have this like what's called, trending credit data. So the way that the credit report reads, it reads your credit limit, your current balances, your pay histories, but kind of below that, we know every month what you paid the previous months, and we can go back a year and I know exactly how much you paid versus what the minimum payment was. So typically, if you're only paying the minimum payment, while that's not a bad thing because you're meeting the obligation of the card, it's not as good as if you're paying off the balances whether it be in full. We typically like to tell people to keep your, you know, your the proportion of balanced credit limits to kind of below 30% if you can. So if you have, you know, $1,000 credit limit, it would be great if your balance at the end of the month was only $300. Now, if it's 1,000 and you're paying it off every month, then that's a good thing. But what I would say is there's always going to be a balance shown on the credit report, and it's typically whatever the previous month's ending balance was or the last time it was reported. So if, you know, if I pulled your credit report today, but you just paid that balance off in full yesterday, it's on the credit report, it's going to be whatever the ending balance typically was from the last month. So sometimes when credit scores are close to like certain limits, we can help you with, you know, giving you advice on what you should be paying, you know, when you should be paying it. And then sometimes we do have to get a credit rescore done. But, you know, that's kind of on a loan by loan basis. A lot of it's not that common that we do that, but occasionally we do have to help people sort of make some, you know, adjustments to their credit to you know, to have a higher score. And typically those higher scores either get you better terms or kind of get you into different programs that might be available to folks with higher scores. So, and then last but not least is, you know, your cash to close, right? So a lot of times people are just hyper focused on how much money do I need for my down payment, and then they don't think about the closing cost piece, right? So typically if you're buying in Maryland, DC, or Virginia, you can expect that your closing costs are going to be somewhere between 3 and 4% of the sales price. So not only are you going to need to come up with a, you know, a 3 or a 5 or a 10 or a 20% down payment, but you should also kind of anticipate that you're going to need about another, you know, 3 or 4% towards closing costs.
And I'll be explaining those closing costs a little later, breaking those down just a little bit for folks.
Yep. And so that's kind of the evaluation process that we look at. And so we put all those, you know, items in a, you know, in our system. And then typically what we'll do is we will underwrite your loan through the underwriting engines that Fannie Mae and Freddie Mac and FHA and VA have available. So that way, when you're making that offer, we've already sort of completely vetted that part of the process. And so the only thing that typically we have left to be done is maybe we're updating, you know, maybe we talked last month and you're buying next month. Maybe we have to get an updated pay stub or something from you. But typically, once you're under contract, outside of sort of signing the loan documents, we've seen all your paperwork, and really we're just kind of waiting on an appraisal to come back and, you know, clear title to come back. And that's another thing that we'll cover later in the process. So I don't know if that answers your question, and if any new questions are generated as a result.
We are exclusive buyer agents and brokers. This is our opportunity to kind of tell you that we are an alternative to the traditional real estate model. We're buyer focused with every single home and transaction that we work in. We don't have any in-house listings. We don't have inventory that we are trying to sell you. We work with you to identify what your needs are specifically, where you want to live in the greater Washington, D.C., Baltimore area. And then again, through communication, like Ramez has said, we take your lead and we shape your home search according to what it is that works for you. Proximity to work, whether you want to be near parks, all these different things that factor into different searches. Listing agents and listing brokerages represent the home seller. That is the typical model where when we access the multiple listing service, we are pulling things from the listing brokerages. There's something called dual agency. It is illegal in many states across the country. It is the action of one single agent representing a buyer and a seller in a single transaction. That is legal in Washington, D.C. and Virginia. You have to sign an agreement, which basically states that you're okay with this single agent representing two sides. And in Maryland, they have something called designated agency. And that is when the listing brokerage, and I'm using this like an umbrella, has two agents. And the one agent is, you know, listing the property. And then they'll have you sign the dual agency agreement because you're going to agree to have another agent at that brokerage work with you. So again, we are the alternative to that. We are exclusive buyer agents and brokers.
You basically have three sort of types of loans. You have VA loans, right? Those are loans reserved typically for veterans, whether you're active duty or retired, or the surviving spouse of someone who died in military service. Typically, you would have eligibility under a VA loan. You have your conventional loans. Those are your loans that are like kind of, I would say privately insured, but basically Fannie Mae, Freddie Mac, buy conventional loans on a secondary market. There's also kind of jumbo loans, which you can kind of throw in the kind of conventional bucket as well. Most first-time home buyers are not getting jumbo loans, so we don't talk a lot about it in this call. And then there's FHA loans, right? FHA loans are loans that are secured by the Federal Housing Administration. They're a low down payment option. You don't have to have perfect credit to get those loans. They're a bit more flexible in their qualifying criteria than a conventional loan. People ask about conventional loans. Do I have to put 20% down? You absolutely do not have to put 20% down to buy a home. And when you see the differences in the numbers, and typically when we have our one-on-one conversation about qualifying, we talk about, what sort of money you have available. How do you want to kind of deploy that money for buying a house? And I'll show you estimates with a 5% down payment, a 10% down payment, and a 20% down payment. So that way you'll be able to see the difference in, is it worth, putting up another $10,000 or $20,000 to get this, what you think is so much better of a deal. Mortgage insurance, which is something that's charged on loans that have less than 20% down, those premiums have come way down over time. So you're not going to, you might not be, people think they're going to pay $400 or $500 a month in PMI because they didn't put 20% down. That is typically not the case. On the conventional loans, typically you can go with as little as a 3% down payment. There's lots of loans out there right now that are sort of specific for first-time home buyers. Fannie Mae and Freddie Mac have their what are called Home Ready and Home Possible loan programs. Also, depending on what jurisdiction you're in, Fannie Mae and Freddie Mac have recently changed rules. So if you're buying in the Washington metropolitan area and one of the home buyers is a first-time home buyer and you make less than like $168,000, which is a pretty big number, you can qualify for some benefits that some of the higher income wage earners wouldn't qualify for. So there's lots of ways to finance loans. Like I said, FHA, that's a loan that's insured by the Federal Housing Administration. That requires a 3.5% down payment. Their mortgage insurance premiums have changed. If you've been watching the news here in the last few weeks, President Biden announced that they were lowering the monthly mortgage insurance premiums on FHA loans, and that's saving customers thousands of dollars a year versus someone who maybe even just bought 2 or 3 months ago with an FHA loan. So that's kind of a big deal. And then with the VA loan, VA doesn't require any down payment. Mm-hmm. And their mortgage insurance structure is a little bit different. They have what's called an upfront funding fee that they add onto the loan, and there's no monthly mortgage insurance. If you collect any percentage of VA disability pay or VA, entitlements to that respect, you don't have to pay that VA funding fee, and you can buy a house with no down payment, with no maximum loan amount. So if you had $1.5 million house and you're a veteran and you qualify for the mortgage with your income and your debts and everything, we can do that loan for you. So the VA loan is a very powerful loan, and I think it's well deserved for the veteran. And we do a lot of them. And we recently were rated one of the top VA lenders in the country because of the way we educate the customer, the way we treat the customers, and the way that we kind of work with the families even after closing. So we've gotten rave reviews for that. So.
Yeah. Yeah. And I will add that, as you can see already into this is why, you don't know which one of these particular programs are going to work best for you. And that's, again, why you're going to be communicating with your lender and hearing all these different options so that you basically get the best thing that is for you. It's customized. Okay, Marshall, you want to talk about
these
this?
are some of the programs that Ramez had been referring to in Virginia's home buying program. DC's the same thing. Baltimore has a number of programs depending on where in the city you're buying. They offer down payment and closing cost incentives. And then if you're an employee let's see, the Baltimore Employee Homeownership Program, Arts and Entertainment District, property tax, or credit are all things that can help you out in the process. I know there's a historical district in Baltimore that can, or if you're buying in that district, you can reduce some of the taxes that you're paying for the next 10 years on it, which is a sweet little deal. And then the 203K rehabilitation mortgage is something that is often available. There are two structures to that, I believe. Is it, Ramez, $30,000 or less on one, and is
Sure.
straightforward, but the more complicated 203K rehab loan gets into having a contractor go through everything, and that gets very complicated. That's a much more difficult one to start. But did you have anything to add there, Ramez?
Yeah, I could touch on the renovation mortgages, right? So there's FHA 203K, which is one of the options, and as Marshall mentioned, there's sort of like a streamlined process, and there's kind of more of an extended process. And then Fannie Mae has it's called home style, right? So what happens is you identify a property you want, it's in the neighborhood that you like, but it needs a bit of work, right? And I mean, they'll lend you hundreds of thousands of dollars to do that work if that's how big the scope of the project is. But typically what happens is you sort of connect with a contractor. They say, okay, this is all the work that's going to be done to this property. That information is provided to us. We provide that to the appraiser. The appraiser says, okay, well, this is what this house is worth today, but assuming all this work is done, this is how much that money, this is how much that house would be worth. And then that, we go to closing, that money is held in a renovation budget and paid out based on a draw schedule. So that's something that we can totally talk about and help with. We're talking about down payments and things like that. And, I tell people, well, if you're going to put 20% down, but let's say you find a house in an area, because typically these 203Ks and renovation mortgages carry a little bit higher terms. Sometimes we'll tell people, you found a house in a perfect area. The house is totally livable, but you want to redo the bathroom and, maybe some part of the kitchen. Typically what we'll do from there is I'll say, well, let's do this. Let me show you the numbers with a 5% down payment. So that way you can use some of that extra money that you have on hand to do that work, right? So that's a different way of kind of doing a renovation project outside of one of these loans. And then one other program that I would mention that we see a bit of is, so the state of Maryland has a program. It's called the Maryland Mortgage Program, and they have what's called the Smart Buy. And if you have student loans of up to $50,000, right? Under this program, you could potentially have some your student loan debt paid off. So that's something that's worth a conversation. Like I said, everyone on the call is going to have slightly different needs. So happy to talk specifically about that. And then I think there's a call. There's a note for you in the chat.
So Simon, I'll answer your question because it's a good one. Simon asks, in dual agency, who pays the buyer agent's commission and what are the common commission? Listing brokerages, when they put a property for sale on the market and they put it into the multiple listing service, they will have on their description of the property, right at the bottom, the cooperative commission. That is the commission that they are offering a buyer's agent, or in our case, an exclusive buyer's agent, as payment for bringing a buyer to the property. That is how we get paid. So it is built into the structure of the listing brokerage and the agreement with the seller. So in a dual agency situation, designated agency, in our situation, the way we all buyer agents get paid is through the cooperative commission.
We've seen that currently the majority, not all by any means, but the majority of listings that we're seeing in the greater Washington, D.C. area, they are paying 2.5% of the sales price. Right. And sometimes it's 3%, sometimes it's 2%, sometimes it's 1% or less. And what the agreement that you have with your buyer's agent and broker is what determines what gets paid. Most buyer agents will work for this cooperative commission of 2.5% to 3%, and accept that as full payment. That is paid at settlement, coming out of the funds that the seller is collecting there. They turn around and pay this through their agent and
And the listing
brokerage.
brokerage,
Yes,
right.
so
Right.
that's how most get paid. Now, you may have an agreement that that your buyer's agent is asking for more than what is being paid there, and depending on that agreement that you have, that's what would determine what you have to might pay out of pocket above and beyond that. We do like to point out that the money that's being paid out to the agents at settlement is all actually being generated by the buyer. The buyer is the one who's bringing the money to the table, and it just kind of gets moved around at settlement that to do that. And this actually, I kind of segue into what the costs are for above and beyond your down payment. Earnest money deposit. Ensure that you're going to move ahead with this deal. It's kind of the collateral that you put down. The money is held either, most of the time, by the title company, though occasionally by the brokerage. It's put into an escrow fund, and which is governed by state regulations. And this money around here, for a long time, like Virginia, you could get by with 1% of the sales price, and so you would pay at to the title company. You pay them 1%. They put that off the side. Now, 2 to 3% is more standard in Maryland in the district. And if you want to have a stronger contract, one that looks better to the seller, and you have the cash to easily do this, because this money is going to be tied up for a while, is 4 or 5% or more, and it looks like it's showing that you are willing to put this money down. And it does actually, it is slightly at risk, because if you default, and default being loosely defined as not being at settlement on settlement day with the money, then that money becomes at risk, and there's the chance that the seller eventually could get that if for some reason you have misrepresented yourself in the money that you have, or the ability to do the deal. So that deposit is, well, we've never lost one, let's put it that way. And we're not in the business of beginning that. So, but this earnest money deposit at settlement, then that comes back out and becomes part of your down payment / closing costs. The down payment, as Ramez mentioned, is kind of determined by you and your lender as to how much that would be, what percentage of the total loan that you're going to be putting down. This gives them this the equity that you start off with in your property. Closing costs, typically 3 to 4%. They can be a little higher, occasionally a little lower, but not often. And those closing costs, they comprise of the transfer and recordation fee. This is paid out to the state and the county, and this is how they make their money on it. It's the tax that they put on this transaction. You'll be paying for title work, the title company, which, and I'll throw this in real quickly, all of these vendors, title inspectors, lenders, all this, are all the buyer's choice. These are all people that you can choose. We have people we recommend because they do a really good job for our clients. But if you have somebody that you know that or that a friend has said, hey, they did a really good job, you can use them. But the title company, they prepare all the paperwork, the title work, and that they collect all the funds that are coming in and then disperse them at settlement. And everything is listed on the settlement sheet as to where the money goes, who gets what. They also do a title search, which means they pay someone to go out and actually check on the title, see if there are any liens, any outstanding claims on the title, so that when you buy your house, you get this house it's completely yours. There are no questions about it. Title insurance. This is paid. You don't have to have your own title insurance, but the lender requires coverage for the liability that they have on this, on the title. So title insurance it covers you for any claims that come up on the title that will need legal costs and things. And it can be very expensive if somebody does make those claims. Rarely is title insurance used. It's a one-time payment that you pay at settlement, and it applies for the whole time that you own the land, and even past that, if something comes back for that period of time that you own the house. So as I said, the title company they take care of all this. Another thing that that included in the closing costs are lender's fees, loan origination fees, other things that the lender is charging. Occasionally, points if you're paying those. This is a point is 1% of the loan that is paid, maybe paying down your rate and that. You'll have to pay for the appraisal. Sometimes that's paid outside of settlement, but other times it's paid during settlement, but considered a closing cost. Roughly around here, I think $300-400, somewhere in that range. You'll have to buy a year's homeowner insurance ahead of time. And this again can be either write a check to your insurance company or have it billed and paid at settlement. But you have to pay a year ahead so that your house is insured. Your lender is going to require that, and then you start. The other thing is that they'll be putting money, will be setting up an escrow account. And this is again part of the closing cost, to where they estimate the amount of money that's going to be needed to pay taxes and insurance, along with the interest and principal on your loan. So they need to collect money from you up front so that they have, when the taxes are due, when and a year is up, when the insurance is due, that they have enough to pay that. So they collect money for this. And then the title company will be prorating things. If somebody has paid ahead in their taxes, or the seller, say the seller has not paid taxes yet, well, you're not going to be charged for any taxes prior to you owning the property. Only that, and same thing with like condo fees, things like that. The water bill, things that they make sure, the title company makes sure that you're not paying for anything for any period of time that you haven't owned that house. So those are basically the closing costs that are going to come up. Inspections, we highly recommend a home inspection for all properties. So there are some situations where, okay, you may be able to get by without one in a condo situation and that, but for the most part, you're going to want a home inspection. Radon tests, around here we have radon, which is the second leading cause of lung cancer in the country after smoking. Pest inspection, well and septic, if the property happens to be on well and septic. These are things that you'll be paying for during this period from when you have the ratified contract to settlement, or at settlement. And we've already talked about the appraisal and possibly a property survey. Lenders are not requiring a survey anymore, but it's something that if you have a property, you think you maybe want to put a garage on it or something like that, to get a survey. You don't need it in a condo, and most townhouses probably don't need a survey either. But it's something you talk to the title company about. They can give you your options and let you know what might work for you. So those are the other costs, other than your down payment, that are all going to add up to what you need to buy a house.
Hey, Marshall.
Yes.
That was fantastic explanation of all the financing stuff as far as the costs go. I mean, you're like kind of going straight down the estimate, but to those on the call, what I would say is we will provide you, as we had talked about, as part of that initial sort of conversation and kind of goal setting, I'll be providing you what he just explained to you, an itemized list of all those expenses. Typically, we will do them initially on sort of like, just sort of examples, but ultimately, when you find a property that you like, before you put pen to paper, we'll have connected and you say, hey, I'm going to write a property on 123 Main Street. Here's the listing, and I will give you that sort of itemized list of costs, go through them, explain them almost as eloquently as Marshall did here. But I wanted to bring up one sort of example of where title insurance, while Marshall says, and it does very rarely come up, but I want to give an example of something that personally happened to me back in the early 2000s. I had bought a house in Virginia, right? and with my brother-in-law, and we were going to fix it up and turn around and sell it. We were going to be like, we were watching some of those TV shows, and we said, hey, we're going to go ahead and do this. And long, I'll give the ending, but it ended, everything turned out fine. But what I would tell you is, about a month or two after we had bought that property and we were looking to, we were in the process of rehabbing it, I got a letter from the IRS saying that the owner who owned this house before me had a $50,000 IRS tax lien, and that I should just kind of remit the payment to the IRS. Because I'm in this business, I didn't freak out about it. Picked up the phone. I called the title company that we closed with. We were totally covered by that mortgage insurance, or I'm sorry, that title insurance premium that we paid. And ultimately, we were able to settle on that house, sell it to the next person. Everyone was protected. And a lot of this has to do with that title insurance premium that was paid. Like, I never even had to reach out to the IRS. I just said, here's the letter. They said, we'll handle it. I don't think they ended up having to pay out the premium either, but nevertheless, we were sort of covered by all that.
Great example.
That's a real life example of something that happened to me.
Yeah,
So.
that is perfect. Creating your needs and wants list. We keep talking about communication, and it is huge. Obviously, you know what you need. You need a single family home, or you need a townhouse, or you need 3 bedrooms. You've got to be close to public transit, right? But it's the wants that get tricky. And I can't tell you how many times I've been out with people when they have suddenly, the want list moves into the need list. For example, some people really have to have a good sized backyard. They want to do entertaining. They live outside more than they live inside. I mean, it's a process. So what I would say to you is communicate. Make sure whatever it is you're thinking when you're going into a house, if you're thinking, boy, do I hate this split foyer. I hope I never see another split foyer. If you're thinking it, say it. Because the minute that you say it to me, I'm going to take split foyers off the list and we won't see anymore. So that's something that I just wanted to bring up. You'll also be looking at a lot of different places. You'll look on Zillow, and Redfin has a great search engine, and lots of different places, realtor.com. Remember that the source of information is the multiple listing service, unless it's a for sale by owner property. So, think of it like a Star Trek ship, right? So it beams down this information, and that information gets disseminated out to all these secondary sources. Those secondary sources may not be as up to date as the multiple listing, right? So you may be falling in love with a place in your price range, but it's been sold for 2 weeks. So most importantly is, again, communication. Send your agent, your buyer's agent or exclusive buyer's agent, whatever you find, so they can verify that property is in fact available.
Determining the value of a property. How much do you offer for it? It's going to come up with a sales price, and that's been determined by the listing agent and the seller. And they will be looking at the kind of the same stuff that we do as we try to determine, okay, what's the current market value of that home? They look at past properties. It's similar, but not the same as what the appraiser does. But they're looking at the same pool of homes in the area. They try to compare like style homes, size, age, things like that, as closely as possible and as close geographically to the home that you're interested in. So we will search that area generally for the last 6 months. Sometimes we'll go back farther if we have to, but to see what is sold at what price, and are the houses similar, bigger, smaller, things like that, to give us an idea of how much an offer, how much we want to make in the offer. Now, this is a good opportunity to add that we're in a market right now that there are not a lot of homes on the market. It's slowly picking up. It's the spring market, as I'm sure you've all heard of. And this is when the largest number of homes come onto the market. But the inventory has been historically low recently, and it'll be quite a while before we come out of that, which means that the buyers are not going to have nearly as much flexibility in pricing, and oftentimes whatever that price is, and we still will try to find out, okay, this house is priced pretty well. This is the value of what it's this neighborhood has been for the last 6 months, but know that the price will probably go up, especially if the house is really good. There will be competition, and that competition is going to push the eventual sales price higher than what you're seeing on there.
Mhm.
Now, there was a short period between when interest rates spiked this last year and when things kind of settled down, where we actually were able to get a few homes purchased with a lower than sales price. Sales are lower than offer price sales price, and we were, it's like that was kind of exciting because we hadn't been able to do that very much in the last few years. But right now, again, it's back to a really tight market. Yeah, very competitive market.
But having said that, our goal is to get you the house you want at the best price that we can get it for you.
Yeah.
And so we work hard at that. There are lots of components that go into making it work for you, which again, we'll move on because it gets layered. Gets layered there. Writing a contract offer in the Washington, D.C., Baltimore area, we have a couple of different real estate contracts. They are written by real estate lawyers, and we basically fill in the blanks with your information. And essentially, we go over this with you. We also recommend, if you really don't understand it, you should go over it with a lawyer. But I can't say this or emphasize this enough. Every contract is going to be different. In Montgomery County, there are many addendums to the contract built in essentially to protect the buyer. Virginia, there's less so. So some contracts will have 52 pages and some contracts disclosures alone. And that means that the listing listing brokerage has the seller fill out a lot of information about the property, and that is provided to you, and then you sign it off. But anyway, as you can imagine, each area, each jurisdiction, in some cases even, counties and neighborhoods will have different things that apply. And we make sure that you go into it understanding what applies to you. So when a buyer and seller have agreed on the terms of a contract, it is called a ratified contract. And that is when the clock starts to tick on all the dates that have been written into that contract and the timelines that are there as well.
Sales price, which you decide on, and then that can be negotiated as after the contract has been sent to the seller. Settlement date. The way we normally do it is, unless our buyers specifically have to have it by a certain date, we ask the sellers, okay, what's the convenient date for your clients? It's one of those things that we can make the contract a little more appealing to them if it has a settlement date that works best for the sellers and generally doesn't cost you anything.
As long as it is what you want.
Yeah, is what you want. Yeah, it needs to fit your side too, but if you have some flexibility, this is good. The earnest money deposit, which I explained before, at that point, that number goes onto the contract, and there's some paperwork to cover that. A lender letter, which is what Ramez would provide, and the seller wants to see that. The seller and their agent want that to be sent in with the contract. And then the contingencies on your contract, financing and appraisal contingencies, both go in. These are ones that protect you. Financing contingency, if you suddenly lost your job, you no longer, through no fault of your own, can go through with this deal. So this allows you to get out of the contract. You'll get your earnest money deposit back, and they will put that back on the market. Appraisal contingency protects you from paying too much. Actually, it's protecting the lender, because as Ramez said, this is the security for the loan, and if it doesn't appraise at the purchase price, then what we normally do, if the appraisal comes in low, we come back to the seller and say, please lower the sales price to the appraised value. And most of the time they do. And then the other main one is the inspection addendum, and this is another contingency. Normally we try to do that within the first 5 to 7 days, even a shorter period if that makes our contract look a little better, where we get an inspector in, they take a look at the house, and you then are either, depending on how the contract is written, are able to either give it a thumbs up or thumbs down, whether you're going to walk away, or if you have a full inspection contingency, then in this case, we come back with a list of things. We send the full report to the seller and come back with a list of things that we either want them to fix or that they will give a credit towards at closing towards fixing them. And that's another negotiation that happens. But these are the things, the main things that go in to the contract that you'll be putting together.
And Simon has asked, good question, Simon. As exclusive buyer agents, do you deal with homes for sale by owner? Absolutely. Any property that you want to buy, because we work for you, we will make arrangements to make that happen. Typically what we do in for sale by owner, they will often offer a cooperative commission. And what ends up happening is we work with that seller in order to make sure that that you have the offer put together the way you want it and come to an agreement with the seller without a listing agent on that side.
Yeah, and we often have to work harder on
Yes, we
those
do.
than
Yes,
we do when
do.
we're dealing with another agent. Some
But that's
other
all right.
agents can drive us crazy, but not having one. And one of the things, and this is something that I've seen through the years, is that when you're working with a
Oops.
realtor that has the R and the circle in that, you'll know that we are all working under code of ethics that require us to be honest at all times. And when you're dealing with a seller who is not necessarily bound by that, they don't always have to be telling you the truth. And so our job is to make sure that you're protected all the way through.
Yeah,
Yeah.
it can be tricky.
Yes, but
Okay.
yes, we do that.
Your contract has been accepted. Now what? The home inspection. Marshall went over this very thoroughly, but as you can see here, we have this great graphic of the person doing their home inspection. But the bottom line is that that inspector works for you. We will send you a list of people that we really like a lot who do a good job. But if you have a friend who's had a good experience, we'll use whoever they recommend. That inspector goes through the property from literally top to bottom. They provide you with a report. They'll include in the inspection anything that you want inspected, and that includes radon, mold, lead-based paint, and we could go into that once we get to that part of the, or we will go over that when we get to that part in the discussion. And then they provide you with a detailed report. We work with you going through the report. We pull out the things that we want to credit for, the things that we want them to fix, and we begin the negotiation with the seller and the listing agent, getting what you want and what you'll feel satisfied with, and coming to an agreement on all the terms of that home inspection.
I'd just like to add, a good inspector is going to be looking for things that are wrong, which is very important. We'll also be pointing out things that are right with the home, and especially if you're a first-time home buyer, showing you things that you'll need to do for maintenance, give you an idea of how long things are going to last, where how to change your the HVAC filter, where the shutoffs are for the water. Ideally, you want to be there and asking questions the whole time, right, to get as informed as you can be about this house you're going to buy.
This is pretty self-explanatory. If you buy into an HOA, homeowners association, if you purchase a property in a condominium or in a cooperative, and these are three different ways that you'll be part of an association, you'll have a built-in review period. That you can look at those documents and make sure that they're running the business properly. We could dive into this more when we get to that point, but in Washington, D.C., you've got 3 days, Maryland, it's 7 calendar days, Virginia, 3 calendar days. And again, what you're looking for is how well run the association is, what their meeting minutes are, what they're spending their money on, what their reserves are, and making sure that you're comfortable. And if you're not comfortable, and we've had plenty of people read through documents and not be okay with it, we get them out on what we just say, we're going to walk on the HOA or condo documents, and you're out of the deal.
Who are going to be reviewing these condo docs and co-op docs and things like that, that's not something that you're used to seeing or looking at. So just know that the lender also looks at these documents. We're not only looking at the financials of the project, but also the general condition of the project. And if everyone remembers, about a year or two ago, there was that horrible collapse in Florida that happened with that condominium project. So when we're doing a loan and a project, a lender will send out a questionnaire on your behalf. And we ask a series of questions above and beyond the documentation that's provided to you in the decks and bylaws and the budgets and things like that about, deferred maintenance. Are there any zoning issues that you're aware of? Are there any, health and safety deficiencies? And the lender is very, very keen to make sure that the project that we're lending you in is not only kind of financially healthy, but also structurally healthy as well. So just wanted to add that piece to
Oh,
it.
yeah. And Ramez, go ahead. This is pretty much your
Okay.
territory here, with the exception of the title, but go
Got
ahead
it.
and tell everybody about all this.
Yeah, so typically what happens is, once you're under contract, you're going to provide docs to us, right? Typically, we've gotten a lot of those docs from you already, so we're just asking for maybe updated information. If you've been searching for a few months, every month I'm not going to ask you for new stuff. So maybe we talked 2 or 3 months ago. Now you've identified a house that you want to buy. You're under contract. We share the numbers with you. We lock into the terms. The next thing is we're getting out the loan package to you to sign. Right, so you're signing through all the disclosures saying, yes, all this information is, true. We get that information from you. We package up the loan. We submit it to our underwriting team. They approve the loan. At the same time, we're waiting for the appraisal to come in. We align that with it. We make sure that's okay. If you bought in a condo or a co-op, we're going to make sure that that's all healthy. And then ultimately, come time for closing, after the attorney has done their piece of work, we're going to present you with what's called a closing disclosure. The closing disclosure are the final numbers, right? Up front, we gave you the estimate. When we disclose to you that loan package, we send you a loan estimate, which kind of keeps us to certain expenses. So that way you're not getting hit with some surprise from the lender at the last minute. This was something that happened many, many, many years ago, and kind of checks and balances have been put in place to make sure that, unscrupulous lenders aren't doing that. And then we will present you with those closing disclosure documents and some of the loan docs ahead of time. So that way you have the ability to review them. So that way come settlement day, you've already seen everything. And it's just a matter of bringing your check, you're signing, that closing typically takes, probably anywhere between a half an hour and an hour, depending on how much you did or didn't read ahead of time.
You'll probably be wiring your funds,
Yeah.
and the title company makes arrangements with you so that you can wire your earnest money deposit as well as the funds that are needed for
You
closing.
don't have to carry around that big fat check.
Right,
That
right.
bring it to closing.
Settlement day, pretty much, Ramez went over it. As you can tell, a lot of coordination that needs to go on. We love the fact that most of our clients, in fact, we've never had anyone say that they didn't feel prepared. We make sure you are ready for settlement day. You know what's happening. You know what to expect. And on settlement day, we're going to do the final walkthrough. Sometimes you do it the night before in the property, making sure that everything that we asked for has been repaired. Everything looks good. It's in the same condition that it was when we were last on the property. And we just work, with your lender. It's teamwork, and with you to make sure that your transaction ends smoothly. And then you have
There it is.
purchased your home.